Welcome back to Aurora Insights. Today we are sitting down with Chris Lowe, CEO of Aurora Mobile, to talk about what 2025 delivered for the company across the full fiscal year. So, Chris, 2025, marked the full fiscal year of GAAP profitability in Aurora Mobile's history. So when you look, at the full year picture, not just the headline net income, but the trajectory across all four quarters, what story does it tell you about where this company actually is right now?
The story is that every major financial metric moved in the same direction at the same time, and that doesn't happen by accident. Q1 set the base, Q2 confirmed it was not a one-quarter event, Q3 pushed us above renminbi 19 million in revenue and into GAAP profitability. Q4 revenue at renminbi 105.2 million reached a historical quarterly high since the transition to pure SaaS business model, with gross profit up 23% year-over-year to renminbi 69.7 million, the highest level in 16 quarters. What the full year picture tells me is that the improvements are structural, not seasonal. Full year revenue was renminbi 374.8 million, up 19% year-over-year. Net income was renminbi 2.6 million compared to a net loss of renminbi 6.8 million in 2024. Cash at year-end was renminbi 173.4 million, up approximately renminbi 54 million from the start of the year. And that increase came entirely from operating performance, not from raising capital. For me, the most important number in the full year result is actually the Q4 operating cash inflow, renminbi 35.1 million, the strongest quarterly operating cash performance since Q4 of 2020. That tells me the business is not just profitable on paper, it generates real cash from real customer paying in advance.
Yeah, and full year revenue grew 19% and gross profit grew 21%. So Engage Labs ARR reached US $10 million with 186% growth year over year. That's staggering. So those numbers tell slightly different stories, about the business. So which metric do you think investors are underweighing, and why?
Most of the attention goes to the revenue growth number and the GAAP profit milestone, which I understand. Both are important, but I think the most underrated metric is deferred revenue, which ended the year at renminbi 178.7 million, a historical high. Deferred revenue is money that customers have already paid us for services they have not yet consumed. In a SaaS basis, a high and growing deferred revenue balance is a direct measure of customer trust and forward commitment. It means our clients are paying in advance, which means they expect to continue using our product and they have already made the budgetary decision to do so. Combined with a net dollar retention rate of 103% in our core developer subscription business for the trailing 12 months, the picture is clear. Existing customers are not just renewing, they are expanding. When retention and expansion metrics are both about 100%, your growth engine is not entirely dependent on new customer acquisition. There is a fundamentally different quality of growth.
Yeah, great point there. And Q4 came in at RMB 105.2 million. So that's 13% above the prior year and exceeding your own guidance, with the full year results now confirmed. So what does the picture look like heading into 2026 and what guidance has management provided?
Q4 exceeded guidance on every major metrics. Revenue of renminbi 105.2 million was above the guidance range of renminbi 94 to 96 million. Gross profit margin came in at 66.3% for the quarter and 67.2% for the full year. Adjusted EBITDA for Q4 was renminbi 7.1 million versus renminbi 1.3 million in the pre-year quarter. For 2026, we have guided full year revenue of renminbi 450 to 480 million, representing growth of 20% to 28% year over year. Within that, Engage Lab is targeting triple digital growth again. Engage Lab ended 2025 with 1,641 customers, up 142% year over year, covering more than 70 countries and regions and expanded into 18 new countries in Q4 alone. We also have 70 international partners in place. Domestic developer services, which include JPush and our core subscription products, is expected to remain broadly stable while continuing to expand into new enterprise verticals. The JPush financial sector momentum, Shenzhen Stock Exchange, China Postal Security, Social Security, all signed in recent months. It also signals that the domestic business has a meaningful run rate in high-value verticals.
Yeah, operating cash flow and cash position are two metrics that sometimes get overshadowed by the headline profitability story. So why do you personally place particular emphasis on cash? And what does the improvement in cash generation mean for Aurora's strategic, options going forward?
Profitability is important, but cash flow is more honest. A company can be profitable on paper while its cash position deteriorates. Strong operating cash flow tells you that customers are paying on time, renewing their commitments, and that optional discipline is real. We went from RMB 119.5 million cash at the start of 2025 to RMB 173.4 million at year-end. That RMB 54 million increase was not from fundraising run or an asset sale. It came from running the business well. Q4 operating cash inflow alone was RMB 35.1 million. Strategically, a stronger cash position means we have greater optionality. We can continue the share buyback program, invest in the Japan subsidiary, expand into Southeast Asia and other region expansion, and fund engagement and moderate product development, all without creating financial pressure that force bad decisions.
Yeah, great point there. And looking at the arc from 2023 to today, Aurora has gone from pulling back from non-core businesses to first GAAP profitability to 19% revenue growth and an international SaaS platform tracking toward triple-digit ARR growth. So what was the single most important decision, that made this trajectory possible?
The decision to stop trying to do everything and focus only on what we were genuinely better than competitors. That sounds simple, but it's extremely difficult to execute. It requires saying no to seemingly attractive business and revenue streams that ultimately dilute your focus and resources. When we pull back from non-core business and concentrate on customer engagement infrastructure, JPush for domestic market, engagement for global markets, and GPT-Boss.ai for AI-driven workflows, we were able to invest more deeply in each of those areas. The depth of investment is what made the product quality competitive enough to win the Shenzhen Stock Exchange, to expand engagement into 70 countries, and to build new platforms like Model-S. Profitability was the outcome of this strategy focus, not the primary goal itself. When operational focus becomes a core discipline and product quality our top priority, profitability will naturally follow.
Absolutely. And the financial trajectory, you have described tells a very clear story about a business that has fundamentally changed its operating profile. So thank you for walking us through it. That is all for today's Aurora Insights.